The following is a presentation of TFNN. Trade what you see with Larry Pesavento. Call now, toll free at 1-877-927-6648 or internationally at 727-445-1044. Now, Larry Pesavento.
Hopefully, testing 1, 2, 3. Looking good, Billy Ray. Feeling good, Lewis. I don't know if I'm coming in yet or not. I'm having a little trouble with the old Skype-a-reno this morning. Okay, that's good. All right, we started to look at the DAX this morning. We looked at the 15-minute chart. And we also looked at the 4-hour chart. As you can see here, we are in a minor downtrend. We had a big break in the market yesterday, but it came back. Again, if we would have used that 10:30 timing thing that Shane Smolden talked about before, which is when the Fed comes in to do their quantitative easing, that was right near the time when the market was turning up, and it gave a pretty good move. The bottom was right near the level that we were looking for, folks. It made a double bottom. Let's put that S&P up here to take a look at it. We got another one that we have to watch this morning that's filling up patterns really nicely, but we'll cover this E-mini S&P first. The overnight low, of course, was down there at 23.17. And then we made another. We tested that low again earlier in the morning at 23.18, and then we had the big move up. Once it went above 22.25, that was when Fed time was there, and that made it to the spot where it looked like it was ready to rally for the rest of the day. In fact, that's what it did. Remember these algorithmic, not only, that's right, Jay, the Dow had been down to 8 days in a row, and that's in a bull market. So that in itself is a very, very rare event. So to get a little bit more of a rally is not unheard of, but if it's really bearish, it just has these little one-day, inter-day rallies and then back down again. So the key level to watch today in this S&P is around the 23.55 level. If we get above that, then we could be looking at several days. But like this happened to us once before. Remember last week we had a quick rally one day and then bang, bang, bang. So that's what happens when these markets turn over. They don't give people a chance to get out of the way on the downside. So that's what we're watching here. Okay, now the next one we wanted to cover. This is something that you folks don't trade too often, but I do want to give it to you because it's got all of the characteristics that you can ask for in a Gartley pattern. Hold on one second here, and if I can, I think this is it. Let's hope for that. No, that's not it. Just a second. Boy, I put these things in categories, and I still get them messed up. I don't know what's happening here. We'll get it going here. Here we are. This is it. I'm almost... Yeah, here we go. Let's put this up here and take a look. I know all you people at the Chicago Mercantile Exchange will be interested in this one because it is one of the live stocks. This is the live hogs. The reason why I'm bringing this up here, folks, when we were down there at about $55, that was when the hogs for December hogs were trading under the cost of production. And, of course, they had a pretty good rally. But what's interesting about this is on the April hog contract, you have your first true ABCD pattern to the downside since the market bottomed 7 months ago in October. Now, in Gartley's book, Profit in the Stock Market from 1937, he said that the best trade is to wait for the bottom to form and then buy the first ABCD correction once that bottom has occurred. And that's going to be coming in probably today or tomorrow, down about a point from where we are now. And that'll be an interesting one to keep an eye on. We'll follow this. Now, I don't put this as a buy recommendation for the 24/7 because I don't want to get those folks involved in trading meats because they get a little bit jumpy at times. But this is a really nice pattern to look at. So, and hogs trade pretty good. You know, they're about half or so of what the cattle trade. So it's not a thin market, but it's still tradable, and it used to be one of my favorites when I traded hogs and bellies and cattle way back in the 1980s. Not 1880s, but 1980s. We stopped trading fed bellies or pork bellies about 7 or maybe 8 to 10 years ago. I don't know. It's been a long time though. But watch this one. I know you've got Mr. Z and some others in there are big into livestock, so keep an eye on that because it's going to be a real interesting pattern if it works. Now remember, these patterns don't work all the time, as we know. Sometimes they work, sometimes they don't, but you pay your money and you take your choice. So that's the real thing that you want to keep an eye on. Now the cattle, they've actually broken out to the upside, and now what they're trying to do now is to pull back. We'll bring this up to let you take a look at it here. Had several requests about this morning, so I know there must be interest in it. But if we take a look at the cattle market, you see they gapped above the 78% level about a week or so ago. Now they're pulling back, and that old level there at 110, 109.80 should be a really strong support level in the cattle. Now, if we go blasting through it really quickly, then there's not going to be any support. In other words, when support should stop between 109.80 and 109, about 90 cents. If it gets below 109, it is certainly not going to be a support point. That's what would be my analysis of that. So, kind of keep an eye on that one too if you trade the cattle market. But the hog market is just a flat out Gartley textbook buy. That's exactly what he said to do. He said buy those first ABCD corrections in a bull market and sell the first ABCD corrections in a bear market. That's what he would be talking about. Now, you wanted to switch over. Yeah, bacon's no longer traded. It used to be. I think they might have something. They probably just don't trade it live anymore. Well, they don't trade any of them live anymore. But I don't believe there's any bacon contracts. I could be. I could be corrected on that very easily. This next chart comes from one of Rich Anderson's clients, that how he evaluates, some of these different markets. Like this is a monthly soybean chart, and he's looking at the commitment of traders, the bullish consensus, the open interest. He puts all of those things into the mix in order to see, where the commercials are playing and where the small specs are, and the large countries and stuff. So they put those factors in here to determine, where these markets are headed as far as a long-term basis. But with March 31st coming, his planning intentions, all bets are off because that's the start of the growing season and the planting season, of course, but not the growing season. And anyway, that'll be a really big one to watch. So we'll keep a close eye on that one for next week for sure.
TFNN is excited to offer a brand new piece of market scanning software unlike anything the industry has ever seen. John Logan and his team have spent years developing their market profile tools to finally be able to release the TAS Profile Scanner Plus. And right now you can get a 2-week trial absolutely free just by visiting TFNN.com and providing us your name and email address. The TAS Profile Scanner Plus is the premier market profile based scanner in the industry, powered by the acclaimed TAS proprietary algorithms, this feature-rich scanner is a standalone desktop software that instantly filters over 2,500 global financial markets such as stocks, ETFs, commodity futures, and Forex. Within 3 minutes of signing up, you can have the software downloaded and running on your computer with a complete roadmap of market indicators and inflection points to trade off using the TAS Profile Scanner Plus. Sign up today and try this amazing piece of software by visiting TFNN.com.
Many of our new listeners have heard about the Tiger's Den, but wondered, what exactly is it? The Tiger's Den is a lively community where professional traders and investors can meet, exchange ideas and information in a comfortable, moderated atmosphere. Hear all of your favorite TFNN shows, plus see all the charts as they happen live during those shows, and have access to all those charts. You can test drive the Tiger's Den absolutely free for 30 days. It will greatly enrich your knowledge of these markets. Details on the Tiger's Den are on the front page of TFNN.com.
The Path of Least Resistance is David White's daily trading newsletter, and if you're looking for active trading ideas, then now's a perfect time for a 30-day free trial to this powerful daily trading advisory service. David uses his years of trading experience to offer his subscribers his trading ideas each morning in his Path of Least Resistance newsletter. Using a combination of equity trades along with options, David keeps his subscribers up to date with all pertinent market information with intraday afternoon updates when warranted. Don't miss out on this great chance to get a 30-day free trial to David's daily newsletter, The Path of Least Resistance, with no obligation to pay anything. David has been delivering solid recommendations for his subscribers recently, and if you'd like to see the type of newsletter he delivers every morning, then visit the front page of TFNN and you'll find the Path of Least Resistance under Trading Newsletters. For all the details and to start your 30-day free trial today, log on to TFNN.com now.
Tiger TV is an exciting way to experience TFNN programming. See high-definition video, giving you crystal clear charts, as well as seeing some of the faces of TFNN's highly acclaimed financial experts with crisp, full-fidelity sound. Catch Tom O'Brien, John Logan, Steve Rhodes, Basil Chapman, Larry Pesavento, Think or Swim, David White, Andy Hecht, and Daryl Martin in crystal clear, high-definition audio and video. Tiger TV, exclusively at TFNN.com. Larry takes your phone calls now. Toll free at 1-877-927-6648. Internationally at 727-445-1044.
Okay, we're back, folks. I'm going to talk about crude oil here for a second. We've had a double test of the 61% retracement level, which is, of course, very, very important, as you can see from the chart that I've just posted in there. So that 47 level is really, really important. Anytime we get above the $49 per barrel level now, we've got a chance to get this thing back to maybe retest 54. That's going to be a pretty tough retest, though, because this market has had many chances to get above it. That doesn't mean it can't do it, but it just hasn't done it, as of yet. One of the questions that we've had is my position on gold. I'm standing on the sidelines wishing I were in. If the old adage is, it's much better to be out of a market wishing you were in than in a market wishing you were out. So I'd like to get in this, but I want to buy it on a break. And the silver yesterday got right up to $8.15. Which was the 78% level. Gold went $1 or $2 above it, but we could easily break out of this, folks, to the upside, and it'll give you plenty of chances. But right now, it's pretty much exactly where we got out of it. At 12.59 about 4 weeks ago. So I'm still waiting to try to. Well, not 4 weeks, about 3 weeks ago. I'd like to buy it on a pullback, but that's what I'd like to do. And that doesn't mean the market's going to acquiesce to that, but that's what I'm waiting to see. It hasn't really popped through, which was a sort of a positive sign for a correction, but it hasn't gone down either. So the only thing negative about that complex now is the fact that platinum is lagging badly and copper's not doing that well, but those are all incidental. They're not, platinum's a precious metal, but copper isn't right now. It might be if it gets any more expensive, that's for sure. Okay, the next question someone asked was about the hogs. that we talked about, this Gartley pattern that's there. Folks, that's just multiple ABCD patterns coming in at the 382 level. And I mentioned before, Gartley said in his book, which I think is probably the greatest technical book ever written, that buy the first ABCD correction in a bull market and sell ABCD corrections in a bear market. And that's what doesn't make any difference what your time frame is. It's just that you have to be able to go in and say, yes, this is what I'm expecting this to happen, because the bottom is in. I'm no longer trying to pick a bottom. I've already seen a bottom form. I'm buying that first correction, and usually that's a pretty good thing to to do, but not always, of course. Now let's switch over here to this Japanese yen, because this Japanese yen is still under a great deal of pressure. Here again, you're looking at a market that is extremely bearish. We're down like 13 or 14 days in a row. Every single rally is only about 50 to 70 pips, and then back down it goes into new low ground. That's very characteristic of a bear market. It looks like the ABCD structure on this Japanese yen here comes in at the 108.80 level, right near 109. So we're about 1.25 points away from that, which means we can hit that at any time. That will be a 50% retracement of the whole move that started, back in June of last year. But the real bull market started in 2011 when Tom O'Brien called King Dollar the king, and it's been the king. Anyway, we'll be watching this as it gets to this 108.80 level. That would be you'll have multiple ABCD markets there. And not only that, but that will be the first ABCD correction since June of last year. So there's another one that Gartley would be having, as a big fire sale sign on his trading desk, I guess. But to watch this about this 108, and of course we could get to the, if it really something really crazy happened, we could get down to 106 or maybe even 103. But this will be the first ABCD correction in the market since June of last year. So that's another one that will be extremely interesting to watch. You mean to tell me that the Japanese yen chart did not post? Please tell me that it did. I guess not. No, I did not. Sorry, boys and girls. Mr. Rogers will get this up here for you. Thanks for letting me know. Let me know as soon as you can, because I'm on the phone. The Skype connection is not to be had today, so there's no way we can get around that. Okay, now we got it up, and you can see the ABCD structure that we got going here in the Japanese yen. It had a lot of resistance, of course, up there at that high level, and now that was several months ago. Now we're in the midst of pulling it back into a area where it would be a pretty good value, I would think. So watch that Japanese yen very, very closely, at the 108 level. As far as this hogs, we're going to use this as a little teaching level for the for these patterns that we look at. By the way, I'm going to be giving a webinar next Tuesday with Rich Anderson. We've have some really great information from some big hedge fund guys that have contributed. Rich is going to be on. I'm going to be on. We're going to be talking about the patterns, the supply-demand situation for the rest of the year, for the plantings. And, of course, the plantings are not what they get out of it, but that's what they're planning to present. And there's going to be some pretty wild swings, because this is the big planning contention report this year. This is like a multiple Federal Reserve thing. So Rich and I will be on for about an hour, and he's going to be talking about option strategies that you could use. And some of these are, really highly leveraged and very low risk, which if they're right, they can do, really quite a bit. So you can go there to www.tfnn, and you'll see it on the front page there for Tuesday night at 6 o'clock Eastern time. 6 o'clock Eastern time, I believe. Yeah, that's what it is. Okay, well, keep an eye on that, because I think it'll be something good to watch. And we'll follow these grains off and on, through the year. But most of the time, I like to spend, looking at foreign exchange, because that's the ones that are the easiest to trade of all the movies, of all the cross rates. We had rain here last night, folks, and it sounded like 1,000 raccoons on the roof of the house, but it's better now. Okay, now we're going to take a look at this dollar index, because this is one that's setting at some pretty interesting support here. This was equivalent to that 109 that we saw briefly yesterday in the euro. We're still very close to that level. It hasn't popped out through the upside, but I think we're going to get very close to that 110 level and possibly even more. Now, the dollar index, if you'll notice, as of yesterday's low at that 90, just breaking 99, was exactly a 61%, 78% retracement of the low from election night. So that's why the dollar is at a real critical level as we come in today, looking at these different patterns that we're watching. So watch it very, very closely here, this dollar index. As we go below the 99 level on a closing basis, then we'll be heading down to that bigger ABCD, which will be down there at the 97.5 level. That will be equivalent to about 111, I believe, in the U.S. dollar. That's excuse me, euro. Wow.
Larry Pesavento has just started his brand new service, Fibonacci 24/7, and he's already delivering content to his subscribers on a daily basis when the market's opened and even on weekends. Each Monday, you'll receive Larry's written report that provides detailed commentary and a summary on the charts and videos that Larry sends out. And throughout the week, when warranted, Larry will send out via charts or videos or both the key markets that he is watching during the day. This will be up-to-the-date, active trading information that will help you in your daily trading. In Larry's first week alone, he sent out 25 charts, 6 videos, and a full report to his subscribers in just 1 week. If you're a technical trader that uses patterns and retracements to trade, then Larry's service Fibonacci 24/7 is something that you must try. Right now, new subscribers can get a full 30-day money-back guarantee. With nothing to risk, sign up now to Larry Pesavento's Fibonacci 24/7 by visiting the front page of TFNN.com under Trading Newsletters. In quiet markets, investors search for new trading opportunities. We'd like to introduce you to a new product that provides opportunities even in flat markets. Nadex, the North American Derivatives Exchange, is a new and innovative Chicago-based exchange registered with the Commodity Futures Trading Commission, and unlike most other exchanges, Nadex allows you to trade directly through them with direct market access when using their trading platform. Nadex never charges a fee to use their platform, which even includes real-time charts and full customization capability. Nadex's unique short-term binary options allow traders and investors to capitalize on strategies even when the underlying markets are quiet. Nadex's innovation has allowed them to come up with a line of unique trading products that are unavailable anywhere else. See how it works at nadex.com. That's NADEX.com, or click on the Nadex banner on the front page of TFNN.com. Futures and options trading involves risk and may not be appropriate for all investors.
Platinum, grains, crude oil, gold, copper, cattle, hogs, gasoline, natural gas, coffee, cotton, cocoa, and sugar. These are just some of the commodities mentioned in the most recent issue of Andy Hecht's Techno-Mental Commodity Report. Andy publishes his weekly newsletter every Thursday morning, where he breaks down the commodity market and provides his subscribers with specific trading recommendations based on his trading methodology. By signing up for a free trial to the Techno-Mental Commodity Report, you'll get a full 30 days to try out this powerful newsletter service and see for yourself the types of trades Andy has recommended for his subscribers. When you sign up for a 30-day free trial, you're under no obligation to pay anything. And should you decide to continue, you will lock in the low rate of only $79 a month. Sign up right now for the Techno-Mental Commodity Report and make sure you're ready to catch the next big trade in commodities. For more information and to get started today, visit the front page of TFNN.com. This segment is brought to you by Think or Swim. For more information, just click the Think or Swim banner on the front page of TFNN.com.
Okay, we're back, folks, and we just finished the U.S. dollar the importance of that 99 level. As you can see here, the euro has got a objective of just about 110. We're trading about 108 and change right now. We hit 109 and change yesterday, so it's still got some more to go to the upside, but the structure of the AB pattern and the CD pattern are very, very similar. In other words, the number of up days in the AB pattern are 23, and the number of up days in the euro as of yesterday were 23. So that would be a sign for a potential correction coming, which is why the U.S. dollar index looks so very important here at this 99. I believe right at 99. I think it got to 98 to 75 last night, but it should hold that level if this is going to be a bounce. And believe me, that market is extremely oversold. I mean, they've been hammering it quite a bit, as you can see with the rally we've had in the British pound, and then also the rally that we had in the euro, the Australian dollar, which the Australian dollar actually didn't rally very much. It was a sort of a surprise to the bulls because the correlation between the Australian dollar and the gold is very, very high, yet the Australian dollar couldn't move at all, yet the gold was able to move, about $17, really quickly. So the key level to watch, of course, in the gold is the 1265 level. If we close above that, this is going to be telling the whole world, I think, or maybe a few technicians, that, maybe this thing does have some pretty good legs, but it will give you some chances to get in, folks. I know I say that, and nothing is as worth as a sold-out bull, but that's the case. I can remember back in the days when I was trading gold at Drexel Burnham during 76, 77, 78. The market didn't go straight up until late 79 and early 80. The last 5 or 6 months, it was in a blast-off, vertical blast-off. But until that time, you would have, $100 rallies in gold and $50 retracements, and it was a fun trading vehicle because it followed all the patterns pretty nicely. But on one particular instance, we were having one heck of a move in gold to the tune of about, I think it was almost $100 an ounce, and I was on the sidelines for the $50 up. I got out of it, $50 higher, then backed off a couple of days, and then taken off like a rocket. So now I'm sitting here with all these accounts, and I'm not long gold, and I want to be long gold, but I can't get it. And then finally, what happened was there was a break in the market. I don't remember exactly what caused it, but I just went in and put my orders in where I had originally gotten out. In other words, I was buying at $50 lower just so I wouldn't lose my position, because I felt so bad about seeing that thing go up, and it was right at a fib point. So I said, well, this is where I got to take the spot, and got very lucky on that one, and that turned out to be a spike bottom, and from then it took off and kept going. So, but anyway, that you're going to catch some, and you're not going to catch some. But like the old adage is, it's much better to be out of a market wishing you were in than in a market wishing you were out. How about somebody that's long bonds? Look what's happened to them other than the last 5 or 6 days. So, those are the things that you've got to think about when you're looking at. Let's take a look at these little bondolis here. This is something that we were watching yesterday. I still think it's in vogue for today. The reason why is that we're making these 78% retracements on both the notes and the bonds. They're both doing the exact same thing, which in itself is rather unusual. So I think it's something that you might want to watch. The bonds up here, this should have some pretty strong resistance at the 152, 03, 04, 05, 06. If it gets to 150, 216, I would say, excuse me, one second, please. I would call Uncle and just stand aside. So the risk on that would probably be about $350 to $400 on the pound, if that's what. And it looks really interesting because the bonds and the notes look very similar, which is in itself very unusual. So that's something I think that we probably ought to remember. Okay. Yes, if you get a 152.60, you'd be smart to get out of that, because that means you're breaking above that old resistance at 78%. And as we know, these markets, have a tendency in long term. This is still very, very oversold, but for short term, it's very, very overbought. So you're not looking for this thing to go from 152 to 146 in a couple of days. That would take longer, I would think, but we'll do one thing at a time and see how it lines up. But the difference between the bonds and the notes is very, very small right now, because they're following each other hand to hand. In other words, the Treasury notes also hit the exact 786 yesterday. We didn't quite do that in the bonds today. That's why I think we've got another chance to get up and hit the bonds at that 152.03, 04, 05. And then to see if it's going to go, so we'll see. Anyway, just because when you look at these gold mining stocks, folks, remember that's not bullion. Believe me, they trade a whole lot differently than you might think, because it's really kind of amazing if you think about it. So that's neither here nor there. Anyway, I think the one to watch today, if you're a scalping trader here today, keep an eye on those hogs. If we get those hogs down about a buck a pound, that would be a pretty good entry point, and I don't think you have to risk more than about 4.5 cents, 1.5 cents on that, which would be the equivalent to just about $450, as I recall. So that's it. Last night we did make a fib retracement in the E-mini S&P when we got up to that 23.43. Now that should be a relatively strong resistance this morning, I would think, and minor resistance would be at around 23.40, somewhere in that ballpark. But again, these markets are poised to go either direction very, very quickly, as we saw yesterday. Watch the 10:30 time frame, folks. Shane Smolian has alerted to that, and I don't know what it is about that time frame. It's like a magnet that I guess it is Fed time, because they come in and the market will either look at it between 10 to that's an hour after the opening. Just take a look at it between 10:30 and 11 and watch to see if that's a potential topping type action or bottoming like it was yesterday. And, then you can have a very, very low-risk trading opportunity. I noticed the people in the den were using that yesterday, so I think it's important to pay attention. Now, someone's asked a question about whether the gold mining stocks have anything to do with the gold. Of course they do, but they act like stocks. They don't act like bullion. Bullion acts a lot differently. There's different types of speculators, folks. That's the guys that own the bullion don't care how it comes out of the ground. They just want it after it gets out. So there's a total different disconnect between the trading community and the mining community. Even though sometimes it looks like it's locked in steps, it usually is not. So those are just two of the things that we want to be watching this morning along with that. I haven't seen the opening in some of these things yet. If you'll give me 1 second here, I want to double-check a couple things. Okay, it's 877-927-6648.
If you're looking to unearth a new financial resource and diversify your financial portfolio, consider the new Market Safe Core Commodity CD from Everbank. This 5-year U.S. dollar-denominated CD gives you exposure to 4 equally weighted commodities: gold, copper, WTI, oil, and sugar, in one powerful CD. With no pricing caps, you can potentially earn an unlimited upside payment at maturity if the commodities increase in value across semi-annual pricing dates. And should the opposite occur, your principal is 100% protected. Keep in mind, returns are based on CD performance. There's no annual percentage yield or periodic rate of interest on this index CD. Don't miss out. With certain commodities on the rebound, now is the time to take advantage. The March 23rd funding deadline will be here before you know it. So call 1-855-750-4051 or visit everbank.com/TFNN for the CD's term sheet and other important product details and disclosures. Once more, that's 1-855-750-4051 or visit everbank.com/TFNN. This advertisement is sponsored content. Everbank is a member FDIC.
TFNN has put together the finest live programming lineup each trading day, featuring some of the most knowledgeable and respected financial minds in the nation to educate traders and investors. On Mondays, Wednesdays, and Fridays, we broadcast 9 hours a day starting at 8 a.m. as John Logan kicks us off each trading day with the Global Market Pulse. Tuesdays and Thursdays, we broadcast 11 hours. Get an early and healthy start to your day as Nico and Paige bring you Living a Primal Lifestyle. Then catch Andy Hecht at 5 p.m. with the Commodities Hour, following the Tom O'Brien Show. Mondays and Fridays, catch live trading on the Nadex platform with host Tom and Tommy O'Brien, along with Daryl Martin on the Bull Bear Binary Option Hour. See the TFNN program lineup via the link on the front page of TFNN.com to get a complete overview of our TFNN shows and hosts. And keep TFNN's Tiger TV tuned in on your mobile device, PC, or Mac for the latest financial news and information throughout the broadcasting day. TFNN, educating investors.
Biotech is booming, but for how long? Whether you think the biotech bull has room to run or has run its course, trade LABU or LABD. Direction's daily S&P Biotech 3 times bull and bear ETFs. Visit directioninvestments.com/biotech today. An investor should consider the investment objectives, risks, charges, and expenses of the Direction shares carefully before investing. The prospectus and summary prospectus contain this and other information about Direction shares. To obtain a prospectus or summary prospectus, please contact Direction shares at 866-476-7523. The prospectus or summary prospectus should be read carefully before investing. An investment in the funds is subject to risk, including the possible loss of principal. The funds are designed to be utilized only by sophisticated investors such as traders and active investors. Distributor Foreside Fund Services, LLC.
Catch the Money Masters as they teach you the art of mastering money when it comes to trading and investing. Next on TFNN.
Okay, we're back, folks, and I posted the chart of the Treasury notes. That's the paper that is 20 years or less, actually 10 years or less, and then the bonds are overlaid on that. You can see they are running tick for tick. In other words, they're hitting the exact fib numbers from those old highs. Before, if you remember, the notes, you see we're making a double bottom where we punch down below that for Treasury bonds. That's when we hit that 116 level. Let's try that again, Larry. The 146 level, and then we had a 5-point rally. This was equal to the same rally we had during January, February. The market still is very oversold on a long-term basis, but short-term basis, we've been up like 10 days in a row with higher highs. That's usually a sign of a pullback. Now, whether we're going to see it or not, remains to be seen. But that's what the probabilities say. As we look at some of these things. One of the questions we've had was about these gaps that we've been talking about in the stock market, and I will put these up here to review these with you again. Market's a little bit firmer this morning. Hold on just a second here. As you can see here, there were actually 3 gaps in the actually 4. The first one was filled right after March the 6th. Then we had the second gap fill at the 20,640. The third gap comes in at the 20,000 level, and the fourth gap comes in around 19,950. So those are the ones that we're watching, is to see. We filled the first 2 pretty quickly, which usually means you're going to be able to take out the other gaps relatively quickly, because if you took out 2 right away, why not take out 3 and 4? Because they're very unusual in themselves, because they show total lack of fear in the market when you're buying. Of course, all these people that bought down at the first gap are doing okay, and also the second gap, but the gaps or the third and fourth, all of those people are now losing. Anybody that bought it, from from March 1st, through the 5th, all those people have now seen whatever they bought. Now, they might have bought a stock or 2 that went up. It was different than the others, but if they bought the indices, then you'd be looking at something, to the downside. So those are some of the things that they keep an eye on. We had one of the questions this morning was about July wheat. Yes, July wheat does have that Gartley pattern. We talked about that at length yesterday, and it's very similar to what we're looking at in these hogs that we're watching. They have the same type of pattern. It's nothing more than a ABCD pattern, and that's really what you're really going to be watching. So keep an eye on it. I think it's going to be an important thing to look at. So it's just a pattern. They're all patterns. They some of them work, some of them don't. The $64 question is, how do you know which ones are going to work and which ones aren't? You don't know. And one of the old jokes that we used to have at Drexel Burnham, there was a broker there. He really had some heavy-duty actors and politicians as his customers, and he would get, his name was Gene Fairman, and he would say, if I go long, I lose money. If I go short, I lose money. And if I don't trade, I miss a heck of an opportunity. And sometimes you feel that way, but you still got to continue on because these patterns will work in your favor over a longer period of time. I'm not saying that they can't go haywire, which they do go, but over a long period of time, and I'm talking probably 100 trades, they're going to be more positive expectations than there are negative, and your risk-reward ratio is certainly heavily weighted, in your side. So anyway, watch it. But wheat happens to be one of those that is fulfilling a whole bunch of patterns and ratios down at that 436 level in July wheat. We had 432.5 yesterday. We're up about 4 or 5 cents so small this morning. Still too early, but we are over the new moon. The new moon is in effect now. That came in last night Eastern time at 10:59, and so if there's any usefulness to the full moon or to the new moon, this would be it, today or tomorrow, because it can't have a warp of more than one day. There's just not any room for error as you're looking at some of these things. So watch it closely in all the things that you're watching, because if these things fail, it just tells you that the market is just not responding the way that you think it is. And here's a perfect example of that is if we take a look at the Australian dollar versus gold, you'll see the correlation here is extremely high. And yet, with the rally that we had in the gold market yesterday, the Australian dollar could virtually do nothing. So that was another thing that was showing that there's some divergence in some of these things as we walk through. Someone's asked me the question, do I think the top is in for the year in the stock market? Folks, I don't know. I think it's too early to say that the top is in. I wouldn't say that the top is in unless we get below 18,000 in the Dow. If we got below 18,000 in the Dow, I don't think there'll be any question that people will be worried about what they're looking at, but it's a question how it gets there, too. Right now we're having a very orderly correction in the stock market. I mean, 1.5% has been the biggest one so far. That's just, look at Apple. Like, Apple had a high of 141.39, and it's still trading at 141.04. It's 35 cents away. But, it could very easily, have a sell-off for a good buying opportunity. But right now, what we're doing is just backing and filling in the stock market. Nothing of any type of signs of anything really bad happening. But that doesn't mean that can't happen in the future. But right now, there's no big breakaway gaps. We have one bad down day, and that was followed by a very, very minor down day. So there's no fear in the market. The VIX index has not even, that hasn't even moved at all. I mean, I think they probably think it doesn't even trade anymore. But if you look at that VIX index, it doesn't go anywhere. I mean, it just it bounces up a point or two here, a point or two there. Now, I will say this thing will be rearing its head, and everybody will say, oh, why didn't I see it back then? But, you can't get people to buy it when it's down here because the overall correction is the overall the tone of the market is bullish, and so no one believes that the market can have any type of a major correction, and that's when the VIX index is most important. And the best way to use that, of course, is to just use buy calls, because you buy a call for a couple months and then you're going to catch something usually within one of those couple months. Now, the last time I did that, it didn't work, but that don't mean the next time that it won't work. So remember, that's just you have to pay your money and take your choice. The trade of the year is history. That trade lost $1.50 on the option that we bought. So I thought the VIX index was going to move in January on the 12th, and I gave it 2 months. It didn't move, and so I have all my attorneys in Chicago looking at why it didn't work, and they got back to me yesterday and said, your analysis was bad. So I guess it was a very small loss. We made up in other things, but that one just did not work, that VIX index. I think it will work later in the year, but right now I am not. That is not a position. I bought that option at 1.45 and got out of it. So we'll see what's going to be happening. We'll see. 877-927-6648.
Hi, I'm Steve Rhodes, host of the Trader's Edge, heard daily at TFNN.com and author of Mastering Probability, a daily investment and trading newsletter service that I send out each morning by 8 a.m. My morning newsletter service covers exactly what the markets have been doing since last night's close, providing you with an edge on your trading day ahead. You get actionable trading ideas, including the exact entry, stop, and profit targets. Plus, I'll teach you the patterns and hidden market correlations that will make you a better trader. As a subscriber, you'll gain access to my 90-minute money management workshop, where I'll teach you the secrets that'll save your assets. The bottom line, I've got your back, including a 30-day money-back guarantee. See for yourself the type of analysis I provide each trading day by signing up for Mastering Probability today. With nothing to lose, this is an offer you should not pass on. Mastering Probability can be found under Trading Newsletters on the front page of TFNN.com.
Tom O'Brien's weekly gold letter, The Gold Report, gives complete and concise coverage of the entire gold market. Inside, you'll get Tom's commentary on gold, the dollar, the rand, the bond, the XAU, the HUI, and detailed coverage of nearly 25 mining stocks. He'll give you the entry price, price target, and stop price of each stock trade. The Gold Report is a long-term newsletter where the focus is on building real wealth through the management of a successful portfolio of gold stocks. With a lifetime of knowledge and almost 12 years of writing his informative weekly newsletter, The Gold Report, Tom O'Brien can provide you with the important market information to help you make better trades in the gold market. Don't let the next bull run in gold pass you by. To get a month-long free trial to The Gold Report, an $85 value, visit the front page of TFNN.com today.
Since 1984, Basil Chapman has been using the Chapman Wave methodology to advise traders of his expert market opinion. While originally hand-drawing charts from the late 1970s into the 1980s, Basil noticed that prices under most circumstances virtually always had a certain number of legs to the upside before declining sharply. Later, Basil found that computer software, which included the standard market technical indicators, enhanced the degree of accuracy in calling price turns as well as market trend calls. Thus was born the Chapman Wave sequence. Using the Chapman Wave methodology along with other indicators, Basil Chapman advises his subscribers of his expert market opinion each market day with his opening call newsletter. Right now, you can get a 2-week free trial to the opening call, Basil's daily trading newsletter, by visiting the front page of TFNN.com. Cancel at any time during that trial and pay absolutely nothing. Get your 2-week free trial to Basil's newsletter, The Opening Call, today by visiting TFNN.com.
This segment is brought to you by Think or Swim. For more information, just click the Think or Swim banner on the front page of TFNN.com.
Okay, folks, I posted the chart of the New York Stock Exchange Index as of Friday to show that we had such strong support down there at the 11,325 level. And then I would like to just reiterate, what happened to this thing yesterday, because this was another reason why the market was, getting ready to bottom. We opened sharply lower in these indexes, and when they open lower right at a 61% retracement, that's why that, if we recall, we were talking about the importance of 2317 and in the E-mini S&P, and we also saw that in the Dow Jones futures at 20,500. But that's neither here nor there. It just shows that it hit support at one time. That's all that means. That means if we go back through that, then it's going to be a little bit more tricky. But right now, we are in the midst of a potential continuation rally. But if we go below those lows we made yesterday, we're going to be looking at some really, really lower prices coming up and very quickly. And I don't think it'll have anything to do, they'll blame it on what's happening in Washington, but it's basically the underlying cycles, that are there. So watch that extremely closely, because we are in the zone for the new moon. That was yesterday, so you want to pay very, very close attention to that as you do your trading today. Keep a really close eye on those hogs today, and then also keep an eye, on the Treasury bonds. If we get those up there at that level, it might be an interesting place to take a position if you're in time to speculate in the bond market. But right now, stocks are basically down just a little bit this morning. Still a little bit too early to make any surmise. The euro is still down, but still holding pretty close to that 109 level. We're trading at 108.71. But the main ones I watch, I think, will be the hogs today, and then also keep an eye on those bonds. Those have some nice patterns in there. The rest of these things look like they could be in for some consolidation.
If you're an active trader looking for that extra edge when it comes to trading and investments, then now is a great time to get a 2-week free trial to Tom O'Brien's daily market letter, Market Insights. Tom O'Brien's daily newsletter, Market Insights, comes out every market day at around 9:30 a.m. and provides Tom's daily commentary on the broad market, including the Dow, NASDAQ, and S&P, plus specific trade recommendations. There's even an update published most afternoons to keep you informed about the day's market activity. He'll give you the entry price, price target, and stop price of each stock and option trade. With Market Insights, there's nothing left to guessing. For all the details and to get your 2-week free trial to Market Insights started today, visit TFNN.com.